What's up guys, Steven Dax here. So today we're going to talk about how to really use pattern into different market conditions. A lot of people ask me that how do I trade XAET, ISEE since they're relatively high market caps. So today I'm going to talk about how to really use these type of patterns to apply into higher market cap and how to be really profitable when you're trading something like 40 million flow or 30 million flow. Let's get into the chart. So XAET is one of the tickers I would trade a long time ago. I think the last run was back in 2017, late 2017, sorry. The stock did a multi-day run, went from 5 to almost 30. As you can see, the stock took a long time to run that far. Typically, we see on lower market caps, they only take about 2, 3, 4, 5 days to run from, let's say, 1 to 10, 1 to 20. It's very different compared to one of the tickers that we just traded called SES. If you take a look at the 1 year chart, look back to October 15th. So on October 11th, October 14th, you only took about 2 days to run from 1 to 30. Just pay attention to the market caps. Market caps around 9 million. XNET market cap is 400 million. At that time, I think it's still around the same market cap. They did an offering there and there. Probably the market cap increased a little bit, but overall, I don't think it changed. SES run to 1 to 30 super quickly in 3 days. XAET went from 4 to 30 and it took about like a month. Typically, higher market caps takes much longer to spike. The same percentage lower market cap can spike. They react slower as well. So when the squeeze comes in, you have to be really patient. When you're trading like a multi-day breakout, you are expecting to hold at least for a couple of days. So XAET, when it started to break out in this $12, $13-ish, it took about 1, 2, 3, 4, 5, 6, 7, 8 days. Went from 12 to 28. Now SES, this one didn't really show a multi-day breakout. So when breakout happened, it extends the range all the way from like 3 to 30, and there's no pullbacks. When you want to trade something like this, first, bigger market caps, you're expecting to hold for a long time. For lower market caps, when you are trading, you are expecting to hold less than maximum 5 hours. And you have to cover your positions or clear up your positions by the end of the day. The reason behind the bigger market caps and smaller market caps is if you do like a math, just by using SES as an example. So if you have a $9 million market cap, it takes about another 9 million to make the stock to increase another 100%. Now, if you have 400 million market caps, you need another 400 million to inject into the market cap for this ticker to spike another 100%. Typically, as a day trader, when you are trading intraday stocks, you have the idea of how much money that all of the day trader has. Let's say when you're tracking multiple tickers at once. Now, this is the highest volume not traded on this ticker. So I'm going to put this ticker that considered as the maximum volume can be traded in day trading. So when you have that volume, you can use that volume times the price to get the maximum dollar traded on that day. So most of the data that I track, typically the maximum dollar can be traded on intraday is around like $300 million. And on XAET, the market cap is 400 million. So let's put the day trading volume into the bigger market caps. So we know the biggest volume or biggest dollar can be injected into a market cap is 350 million in 1 day. For XAET to spike 100%, then you need the maximum dollar to be poured into the ticker, which is not possible. Out of 100 samples, that there's only one can be traded that much volume. So when you see a bigger market cap that is spiking around 100% or 200%, you will know the stock is likely to pull back. It's because you know there's only limited amount of money that exists in day trading. When you're shorting to a parabolic, you can use that number, you can use level 2s, you can use price actions to direct you to place like a short entry for bigger market caps. Now, let's talk about intraday actions on bigger market caps as well. Take a look of XAET that ran for the last couple of days. As you can see, the stock gapped up huge into the $6 area. What we normally see is when the stock performs the first red day after a huge resistance created on that Friday, which is October 28th, when the stock has a really trash fundamentals, all we see is something like this. CEI went from 3 to 5 and took about 2 days, went from 5 to 2.5. And you can see the stock went down exactly where it started. On XAET, it's completely different. So when the stock created a huge resistance and start to downtrend, So for bigger market cap stocks, they generally have a little bit more fundamentals compared to smaller market caps that we trade. And there is a maximum pullback percentages that I tracked for almost a year. That most of the bigger market caps, when they perform a first red day, there's only maximum negative percentage they can go. So for that percentage, it's around negative 26%. So when I'm trading something like market cap is over 200 million, and I'm shorting into a first red day, if the stock gap down, let's say negative 15%, in my mind, I know the stock maximum pullback percentage is negative 26%, then I only have about another 10% to go as a risk reward. So I'm not going to short using pattern called first red day. And that's my thought process when you are trying to trade the first red day. Now for lower market caps, you can use first red day and to ride it all the way down because most of the micro caps, they have really bad fundamentals and they likely to do an offering. People don't want to really hold overnight. They don't want to really hold throughout the day. Then they dump the stock and people trying to manipulate, they also dump the stock as well. The negative percentage can increase to negative 50%, negative 75%. So this is why the stock has potential risk reward if you're shorting after first red day. Now, when you're shorting into a bigger caps using first red day, it doesn't really work as well. Now, the final point, when you take a look at the charts, just pay detailed attention into all those panics. You see right here, morning panic, hold, double bottom, push back up, panic, hold, push back up, panic, hold, push back up, panic, hold, push back up. There's a specific repeatable actions on this type of bigger market caps. If people are applying the same strategy into these bigger market caps, it's because they don't really understand some of the fundamentals are very solid. And when they're trying to short using that resistance, they get rejected by the end of the day. I think I talked too much. Is it? So the final point is the bigger market caps, hard to drop. Smaller market caps, very easy to drop when they're shifting momentums. When you want to look for a dip buy, look for a dip buy that trades a tons of volume. That's number one. Number two, you are looking for a large pullback, something like 15% or plus. Number three, when you track data and you know what's the maximum pullback on those bigger market cap stocks, then you can use that data to direct you to get a very good long positions, especially when people are trying to use the first red day pattern imply into the bigger market caps, and you can use that reverse psychology to dip buy into that double bottom to be able to get a decent profit. So that is all the points for trading bigger market caps. Let me know if you have any questions. Make sure to click the like button and subscribe. So that is all the points for how you really trade the bigger market caps. If you have any questions, make sure to leave a comment below and click the like button. Make sure to subscribe as well.
See you in the next video. Cut!
Alright. And I'll see you guys in the next video. So that is all the points of how to really trade bigger market caps. Let me know if you have any questions.